This is the CRA Podcast, a podcast committed to highlighting the great work across the nation in transforming communities through the power of economic development and the Community Reinvestment Act. And now, here's your host and CRA enthusiast, Linda Lewis-Izuka.
Welcome to the CRA Podcast. In this episode, we'll learn more about the Entrepreneur-Backed Assets Fund, or the EBA Fund. It's a new nonprofit creating a secondary market for microloans. The EBA Fund is a new tool to help capitalize CDFI lenders doing amazing work to serve entrepreneurs of color, small businesses in low-income communities, and the millions navigating through this pandemic. Today, I have the great pleasure of interviewing Brett Simmons and Joyce Klein. Brett Simmons is the managing director and principal with Revolve and leads fund management for the EBA Fund. He has more than a decade of program planning and entrepreneurial experience across many industries. Joyce Klein is the Director of Business Ownership Initiative at Aspen Institute and also is the board chair at the EBA Fund. She is a recognized expert in the field, speaking at national and regional industry conferences and being quoted in a variety of news media, including the New York Times, the National Public Radio Marketplace, and many more. She has over 20 years of experience in studying and supporting microenterprise and entrepreneurial development programs in the United States. More information and biographical information is available in our show notes for these two esteemed professionals. To learn more about the EBA Fund, I'll also have links in the show notes as well as a primer on microenterprise. So today we'll be talking about microenterprise and how the EBA Fund supports microenterprises. So the term microenterprise, also known as a microbusiness, refers to a small business that employs a small number of people. A microenterprise usually operates with fewer than 10 people, typically less than 5, and is started with a small amount of capital, either advanced through a bank or more often a CDFI. Most microenterprises specialize in providing goods and services for their local communities. We'll learn more about microenterprise in today's interview. So now it's time to sit back, relax, and enjoy the CRA Podcast. Brett and Joyce, welcome to the CRA Podcast.
It's great to be here. Thank you.
Thanks for having us.
Okay, so as I mentioned earlier, the EBA Fund is a new nonprofit creating a secondary market for microloans as a new tool to help capitalize CDFI lenders. At the most elementary level, the EBA converts the value and promise of entrepreneurship into an asset recognized by mainstream financial systems. This translates to the communities we love, the businesses we frequent, and the financial system itself will benefit as a result. So Brett, as the fund manager for the EBA Fund, can you share your initial vision for the fund and how it came to fruition?
Yeah, definitely. Thanks, Linda. So as you can imagine, we're really big admirers of CRA and its potential to drive capital access to businesses in low to moderate income areas. We're also big believers that small dollar loans are critical for entrepreneurs of color, which Joyce will talk about more, I'm sure.
Yep.
So over the last decade, as small dollar small business loans have decreased from banks, we've thought that there must be a better way for a business transaction to happen between banks looking for CRA and CDFIs to need capital. So we started that work at Axiom Chicago, a CDFI in Chicago, selling loans predominantly in Cook County, Illinois, which is where we learned that a business transaction is indeed possible between the bank and the CDFI. And compared to alternatives that the bank might have for finding CRA small business loans, we found that there's a lot of value for both the bank and the CDFI. So several years ago, two of my colleagues from Axiom and I started a company called Revolve, and we started working with CDFIs to help them sell loans to banks directly.
Great.
In that new business, we started to run into quite a few challenges, as you can imagine. So CDFIs wanted to sell loans when banks weren't ready to buy them, or we would find a bank who wanted to buy loans, but they had a multi-state footprint and they didn't want to work with 7 different CDFIs.
Of course.
So that's when we started working with Joyce, actually, and 6 CDFI microlenders that form what's called a Microfinance Impact Collaborative.
Mm-hmm.
And over about a year of work with them and that partnership, we decided that the best way to make this whole transaction work, this business transaction, was to start a new nonprofit that could remove a lot of the transaction barriers that stand in the way of CDFIs selling loans to banks. And that is what is EBA Fund today.
Excellent. Very impressive. Removing those pain points and opening up the free flow of capital. Great. So Joyce, as chair of the board of the EBA Fund, you secured an impressive list of early adopters to support this work. Can you share more about your philanthropic investments as well as those for-profit impact investors that help fund your initial vision?
Yeah, certainly. So we actually got the fund up and running earlier this year, but we made a formal announcement in December when we had brought our 5 first investors and supporters into the fund. Those 5 supporters and investors are the Citi Foundation, the Bill and Melinda Gates Foundation, the Robert Wood Johnson Foundation, all of which made grants, and then Woodforest National Bank and Microsoft Corporation, which have both made investments in the fund. And they all have slightly different stories about why they came. So Citi Foundation provided our first commitment, and the Citi Foundation and also Citi as a bank are longtime investors and supporters, not just of CDFIs, but also of microfinance, both here in the US and globally. And they had been a longtime partner of our work, my work at the Aspen Institute in a program I lead called the Business Ownership Initiative, in the work that we had been doing for many years to support and grow micro lending in the US. And so when we approached them with this idea, they got it right away. And what they got was that CDFI micro lenders really needed another financial tool to be able to grow. And so they've been a tremendous supporter of ours. The Bill and Melinda Gates Foundation was a really different story. Their grant to EBA Fund is actually their first grant to support CDFI small business lending. And they came to it because they're very concerned about economic mobility, very concerned about racial equity, and really concerned about what was happening to small businesses, but also to the employees of small businesses, who are some of the folks that they care about. And I should note, I think they're certainly not the only ones these days who are concerned about what's happening to small businesses. Janet Yellen the other day tweeted about how this was going to be a huge priority for the Treasury. It's something she spoke to as Fed chair. So that's the Gates Foundation. And then with the Robert Wood Johnson Foundation, we had started actually by talking with the folks in their new impact investing practice. The leadership in that part of the practice is really familiar with CDFIs and also with small businesses. Again, got this idea right away, wanted to help us keep going forward, and came in very quickly with a grant that also helped to support some of that initial sort of equity base for the fund. And then on the investment side, we have Woodforest National Bank, which is somewhat newer, I think, to CDFI investing than some other, certainly of the other larger banks, but has been really creative in its approach. Woodforest had actually already purchased loans from some of the CDFIs we work with because they knew it would be a tool to get them liquidity. So they knew the value of the strategy and were really interested in trying to, sort of help make those transactions work. They are doing an EQ2 investment, an equity equivalent investment in us. And it's really important for us to have that structure for our balance sheet. And they've also expressed interest in partnering with us in other ways as well. And then finally, Microsoft Corporation, I would say, I think we've probably all seen the many announcements from large companies that are really focused right now and committed to addressing issues of racial equity and what's happening to small businesses owned by people of color. And for them, it was really thinking about how they could use the cash in their treasury to forward that goal. And so they have provided us with an investment at a really affordable interest rate, which is really helpful to us in terms of our long-term business model. Because their real issue is, what do we do with this cash instead of having it sit there? How can we really use it to forward some of our social and our economic justice? We are still continuing to raise capital to allow us to do more with the 6 organizations that are members of our collaborative, but also to bring on other CDFIs. And I think the final thing I might say is just, ultimately we think the EBA fund can be entirely self-sufficient from the money that we earn through the secondary market, and also drive 75% of the financial upside from those transactions back to the CDFI partners.
Wow.
And that's really the goal we're after is to drive financial benefits back to CDFIs that are out there in communities originating really needed loans.
Wonderful. You have such an outstanding list of early investors, and it's pretty exciting that, you have an EQ2 in there. It's such a rare and beautiful thing from your balance sheet. I did those, 15 years ago, and it just seemed to be so rare nowadays to actually secure a EQ2. So congratulations on that.
Yeah, we're excited.
Yeah, exactly. And this is really the year of the CDFI, right? It's finally going to be a major tool and movement to support our disadvantaged communities. And it's so nice to see new philanthropic partners coming to the table. So congratulations on that.
Thank you.
Linda, if
Yes.
I could just interject one quick point. So
of course.
not only did Woodforest make an investment, but they actually went a step further than many organizations doing EQ2s now. So the structure of their investment is actually into an LLC that'll be owned by EBA Fund, which allows us to show the investment as a net asset,
Wow.
which most EQ2s don't allow you to do. And it's just that Woodforest was willing to consider a much different structure than some other banks have on the EQ2 front. So it really is an investment.
Wow.
And they'll get their same Part 24 investment credit.
That's great, Brett. Well, we need another podcast episode, I think. Wow, that's amazing. Okay, so many of us have been at this community development work for some time now, but some folks are still newer to the concept of CDFIs and microenterprises. So Joyce, can you tell us just a little bit more, provide a short little primer on CDFI microenterprise as the tool for diversity, equity, and inclusion?
Yes, absolutely. So I should start, I think a useful frame is my work at the Aspen Institute. It's at something called the Business Ownership Initiative. Mm-hmm. And what we are focused on is expanding economic opportunity through business ownership, and really focused on how do we get resources to the business owners that face in the US who face the greatest challenges in starting and growing in their business. And we do research and policy work at the national level, but in very close collaboration with CDFIs. And over the period of our work, but particularly in the last, I'd say 6 or 7 years, we've looked really deeply at issues of access to capital for businesses owned by people of color. And most deeply, I would say, for Black and Latino entrepreneurs. Mm-hmm. And I think what we see when we look at the patterns of what happens with those businesses is that there is a set of structural and systemic factors that have prevented, in particular, Blacks and Latinos from building wealth that have real consequences in terms of the size of their businesses. So what we clearly see in data from sources like the Fed or sources like the JP Morgan Chase Institute mm-hmm. is that the revenues and the margins of businesses owned by Black and Latino business owners are much lower than those for white-owned businesses. And that's partly about the fact that they struggle so much to access capital. It's partly about the industries that their businesses are located on. And both of those things actually flow, again, from sort of systemic and structural factors. Mm-hmm. But then what happens is that the smaller size and the smaller margins for those businesses yes. affects the amount of debt they can absorb.
Right, right.
And so what that means is that most or a large number of businesses owned by Blacks, owned by Latinos, can only absorb much smaller loans. And so what that means is microloans or loans of $50,000 or less are really important in sort of leading those businesses where they are.
Absolutely.
So that's part of the story. The other part of the story is that CDFIs have shown that they're much more effective in reaching entrepreneurs of color and communities of color than more traditional financial institutions. Right. And there are a set of things that CDFIs do to be able to do that. I'm not going to go through a lot of them, but one of the challenges that we've seen in the micro lending space is that the economics of these loans aren't good.
Right.
So if you're charging what's really an affordable rate, a loan of less than 25,000, probably for sure, is not profitable. Loans of 50,000 are probably marginally profitable, maybe. And that's why many financial institutions don't want to make them, or they don't make large numbers of them, because just the economics aren't good.
Sure.
And just as an example, like we saw this in the PPP, that one of the reasons that so many small businesses were left out, especially before lots of CDFIs were let into that program, was because they needed smaller dollar loans. And the economics of making them under PPP were not good.
Right.
So fortunately, what's nice about the most latest, I don't want to go too far down that PPP road, but the latest round of PPP helps to correct for that a little bit.
Absolutely.
But this is not just an issue with the PPP. It's an issue for all smaller dollar small business lending. And what EBA Fund is doing is really targeting that problem, which is, how do we improve the economics of micro lending for CDFIs, because that will enable them to do more lending to entrepreneurs.
Right. And I often say that the CDFIs are partners to the banks in terms of the deployment of capital, right? And that, CDFIs are able to do so much more based on, some of the bank's regulatory barriers, so that, you could remove those barriers and CDFIs can provide that technical assistance that's so important to be paired with that capital. And then it's just so powerful. So I want to switch gears here a little bit, Brett. And for those that are newer to this community development space, can you share how bankers might support the EBA Fund from a fundamental perspective and how it relates to their CRA program?
Yeah, so I think most importantly for us at the moment, and I think in the long term as well, is to help make EBA Fund a successful marketplace for the microloans. So we think we've improved the buying experience from the CDFI significantly with how we put together EBA Fund, which means we've created a more reliable and broad source of the small business loans. But ultimately, the biggest impediment for us is getting banks to do that initial work, which I think is always the biggest challenge for any CRA officer, is gaining internal traction and approvals for something new.
Right.
And it really is a mindset shift for many banks. And we provide a lot of initial Q&A support, collateral materials. We've presented to bank leadership teams. But, ultimately, it requires that initial time and energy to just go through the model, think about the economics, and make a decision about whether to try this with us. So I think for us, that's really the biggest hurdle as a new organization, is getting those banks that want to get onboarded and want to buy loans and are willing to take the time to do that. And I think once that happens, things can go really fast. So we really unexpectedly did a deal at the end of December with a bank, and literally it took 3 business days from them saying, yes, if you have loans in our assessment area, we'll purchase them.
Wow.
I didn't think we could do it in 3 business days, but now we know we can. So, and that's not a promise to any bank listening. We can do it in 3 days.
Well, congratulations on that feat.
Yeah. But then once a bank's in our system and understands our process and has done the legal approvals, it really becomes, a long-term partnership where a bank needs loans that are under $1 million in gross annual revenue, or they need loans in LMI census tracts. They come to us and talk to us about their specific needs. In 24 hours, we can get them a list of what loans are available. And some of our initial transactions are really small. So we know it takes time and people are a little risk averse the first time through. So we've done small transactions of 7 or 8 loans, but we know that over time that bank will potentially be willing to purchase more. And I guess from a CRA perspective, we just feel like this is a really great tool. The reality is bank lending demand fluctuates, strategies change.
Yep.
CRA officers are often playing catch-up mode when they get monthly or quarterly data dumped on them.
Right.
And being able to go to a leadership team and say, if you can spend a few hours on this with a few key people, we can make a decision about how this fits with our business. And then we can continue our bank strategy, but know that we can know confidently that we have access to small business loans to help fill out our performance on the lending test. So that's really, for us, is the key, is being able to make this a tool that works for CRA officers and a tool that works for CDFIs. And then ultimately we drive more capital back to the CDFIs. Now,
Right.
of course, I would be remiss to say if someone wanted to make a $2.1 million grant to us, like the Citi Foundation did, we are still trying to raise, net assets to build up the scale of our fund. So if anyone is in that ballpark,
that is a brilliant opportunity for sure. Very good. So just to follow up on that, so this supports their investment, right? Their community development investment activities, right? Where they actually they look at their loan data, and perhaps they're doing a CRA self-assessment, as I advocate for often, and then they identify that there's a gap in their lending performance in a certain assessment area. They can actually come to the fund and they can say, here are my gaps. Do you have anything in those areas? And then you say yes, you turn that around quickly. They're able to place a small investment in the EBA fund, correct? Did I get that right?
So rather than being an investment, it would be, they say, I need 20 loans in a moderate income census tract in Kansas City.
Okay.
And if you had those, it would push up my distribution performance. Do you have them? And then we actually sell those notes in a participation structure. So it's 100% participation. And the bank then books the loans on their system so that they can report them as if they had done the loans themselves, so they would count on their lending test.
I get it. Okay, so this is the opportunity to purchase the loans. Excellent. Yep. Okay, wonderful. So then it's part of their lending performance.
Yep.
Brilliant. Okay, thank you for that clarification. Now for a deeper dive, given your role as fund manager, can you share a little bit more detail on the EBA's approach and strategy, again, around this loan purchase and concurrent donations to support the secondary market for CDFIs? A little bit more about that structure that's quite innovative. We'll also provide a presentation deck and illustrations in the show notes, but can you explain this unique structure for our listeners?
Yeah, so I think the key to understanding what we're doing is that there are really two separate transactions from the bank's perspective.
Okay.
So first, we do a really plain vanilla participation agreement. So if a bank has ever done a participation agreement, this is going to look similar to what they've done.
Yep.
And in that case, they're buying 100% participation interest in basically a bunch of $10,000 average loan sizes. And we're assigning them our interest because we've already purchased the notes. So EBA Fund goes out and buys the notes, and then we assign our interest to the bank and we facilitate their monthly repayments. And in that case, the bank is paying basically the face value of the note, which in this case, I would say is really a market rate for the notes. So that means the bank might generate anywhere from 2 to 4% income on the purchase of the notes, depending on their capital cost. And then in that participation, they also pay a servicing fee, which is $20 per loan per month.
Okay.
So that's one transaction. And then, as Joyce explained, the loan income, which I just described, 2 to 4% potentially, is definitely not sufficient to cover the costs the CDFI has when it comes to dispersing hundreds of these small dollar loans.
Right.
So all that work to underwrite and support the clients, all of that is why they're a nonprofit.
Right.
And the more clients they work with, when those are the economics, the more money they lose. So then they need more philanthropy, and then they have to go borrow more money. It's not an economic model that really works.
Yes.
So I think the real twist is the second transaction. And I just want to try to illustrate some of the economics here, because I think it's important as people think this through. So let's say a bank these days has an average small business loan of $200,000 to $300,000 in size. I think that's pretty typical for banks that do a fair amount of small business lending. That's at the size where they're going to start to generate some interest margin beyond their marketing and operational costs to originate that loan in the first place. So if that same bank at the end of a CRA cycle or quarterly finds that they need those 20 notes in LMI census tracts to boost their distribution to ensure that they're going to get that satisfactory outstanding performance that they want, it can be a really hard gap to fill. So if they're trying to go find 20 $250,000 or $300,000 notes they're going to have high client acquisition costs. They're ultimately going to need $4 million, $6 million in capital just for the loans. And in many of those LMI communities, as Joyce described, businesses aren't looking for loans that size. So what you're really trying to do is fit that, proverbial square peg in a round hole. And I think as anyone knows, trying to do that's an expensive process. So basically what we offer them is to say, look, if you need 20 loans, we have them in LMI census tract. They're $10,000 loans. So you're going to spend $200,000 to acquire the loans. That's less than their average small business loan size. And because they're looking for distribution benefit, the 20 units that are $10,000 loans are really going to count the same as $300,000 notes. So, and all the notes are typically in LMI census tracts. 99% are under $1 million in gross annual revenue. But most importantly, the banks we work with, they choose the notes that they want. So it's not like, here's 50 notes and 20 are actually in an assessment area that you need.
Okay.
It's here's the 20 notes you need in your assessment area. So then the bank's in this position where rather than spending that $5 million or whatever that number might have been, they spent $200,000, got those notes, and they can take the difference, the $4.8 million, and go invest it in something else where they generate their average interest margin. And that's really the case that the CRA officers we initially work with have to make back to their leadership, is that this ultimately helps us streamline all of our efforts and has a huge benefit for the community, and is just, it's easier and more reliable. So what we've found is that once that case is made and bank leadership understands that, what they realize is that paying $200,000 for 20 notes is a huge value added to the bank. But the reality is it's not covering the cost of the CDFIs. So what we ask the banks to do is concurrently donate to EBA Fund to just help make the secondary market function. And then we donate 75% of that back to the originating CDFI. And that helps them cover their costs and when it comes to loan income that they're losing out on, plus just cover the costs that they're never going to cover from loan income in the first place. And typically that donation ranges anywhere from 20 to 35% of the loan balance sold. And because it's a totally separate transaction, the participation agreement is one legal agreement, the donation is a separate legal agreement. That donation would flow to the CRA investment test.
Got it. Right.
The lending test would benefit from the participation agreement.
Yep. Got it. Okay.
So those are the weeds.
Great. Oh my God, I love the weeds. Excellent. So this is the opportunity so these EBA transactions allow the banks to get both CRA lending credit in those hard to reach areas, as well as investment test credit from their charitable contribution. And not only that contribution then not only goes to EBA Fund, but also to the CDFIs that originated the loan originally, right?
Yeah, so we have a standing agreement with every CDFI that works with us that when we generate any additional income on the notes that we've purchased from them, we will share 75% of that back with the CDFI. So the whole goal here is, and the reason the EBA Fund is a nonprofit is because we just want to be a lean organization that's generating value for the CDFIs, because those are the people on the front lines that are making these loans possible.
Right.
And that's the most important outcome of all.
Yeah. Oh, that's powerful.
Linda, can I just jump in for a second? A few points. I think one point is exactly what Brett said, that we designed this. And when we designed it, first of all, it came out of the experiences Brett showed or explained of that he and colleagues had when they were at Axiom in Chicago. But we also designed it in parallel with these 5 other micro lenders who were part of our collaborative, so that it was really designed as, how can we create a tool that's really going to add value and help you solve the biggest challenge you face in growing your loan portfolios. And so I think that's really important. And then the other thing that I would make is what it does is it says, like, CDFIs are really good at originating and servicing loans to people who are excluded, to people who are in communities that banks really reach. They need new capital tools. Right. And so we're pairing them with the capital from the banks and motivated by their need and their desire to invest in communities. And we're putting those together to make these transactions sort of benefit both parties.
That's great. Good distinction. Thank you so much, Joyce. Can you tell me more how banks might be able to identify a certain assessment area that they have interest in, and then how the EBA fund might then source? Since you're a startup and you have deep relationships with CDFIs, tell me a little bit more about how you actually look at your portfolio of loans and then reach out to the CDFIs to the extent that there might be a gap from what you already have access to. Can you just expand on that a little bit more?
Yeah, so it's kind of a two-stage process. And I think both stages are really important to the impact of EBA funds. So I'll start with the simpler one, which is that we've got these 6 lenders. They have more than 11,000 small dollar business loans. Those are some in very rural areas, most major metro areas, many smaller metro areas. And so when a bank comes to us and says, this is our assessment area, the first thing that we do is we go through all of our loans, which are sorted by county, they're sorted by census tract. We can very easily pull out and say, these are the exact loans we have, these are the census tracts they're in, et cetera. When we go through that process, if there are not many loans in that bank's assessment area, I think it triggers sort of that next stage of work on our part, and the next stage of impact for EBA fund, which is that, as Joyce mentioned, microloans are really important to serving entrepreneurs of color. They're really important to serving low to moderate income areas and women entrepreneurs. But the reality is the current footprint of CDFIs that do microlending is not as large as it could be or should be.
Okay.
And that challenge is that, as we said, the economics of microlending are difficult. There are many CDFIs that have sort of toyed with doing it, but have never grown it as part of their portfolio because they don't make much money doing it. So what we would do in that case is we would go find CDFIs that we know in that footprint. That could be Arkansas or Tennessee or Mississippi or Hawaii, and say, we go find those CDFIs. We know microlending really well, and we have 2 levels of partnership where we'll add partners that have microlending experience and basically, hold their hand through the process and do our due diligence with them. Or we'll actually onboard a lender that has very limited microlending experience, and we'll use our expertise to help them start growing their microlending. The key here is that there are some banks we know that we might have some loans in their assessment area. I haven't found a bank yet where we don't have some loans in their assessment area. So we can start the process with them of going through the due diligence and get the sign off from their leadership that if there are more loans available, that they'd be willing to purchase them. And then we really have that demand pull where we can go to a CDFI in one of those markets and say, look, you haven't done microlending before because we know the economics are hard, but we have this new nonprofit that's going to help you do it in a more cost-effective way. And we have this bank that has already committed that they want to help grow microlending in their assessment areas, who will buy your notes through EBA Fund. So that for us is, we can grow the organizations, the 6 that we work with, help them continue to scale. But for us to really broaden our impact, we also have to bring on those additional CDFIs. And for us to do that, we really do need bank direction. We need banks that are willing to step up and say, come here and help us work with CDFIs to make this a reality in our assessment area.
It's an outstanding opportunity for all. Wow, that's great. That's
Linda, can I add one more piece to that? I think this works best if both the CDFIs and the banks have sort of a long-term view of the relationship with EBA.
Sure.
So banks want a reliable strategy for meeting their, small business lending distribution test. And CDFIs want to invest in sort of financial strategies that are going to work for them over the long term. And so to the extent that each of those entities knows that there's a longer term market here, that the CDFI can sell its loans when it needs to, and that a bank can acquire loans when it needs to, that's where I think the fund and the market really works. And so, having bank partners come on who say, this is a longer term strategy for us and one we're going to invest in, over time, because it makes sense for us, is the way to really sort of maximize the value, I think, and make the market really.
Right. Brilliant. Yes.
Which I think is, just builds on this idea that like we could run EBA Fund like an online marketplace, right? Like we could post loans and the highest bidder gets the loans. And but the reality would be that as a CRA officer, that puts you in a position where if you don't have the funds to bid the highest amount that quarter, suddenly the strategy doesn't work for you. And so what we really want to do is actually create long-term partnerships with banks.
Right.
So if, you know, in the Dallas market, for instance, we have some loans on our books in that market. If there were 3 banks that were reliable purchasers of those loans, that would be enough, right? Like we wouldn't need to go out and market around and find more banks that want to purchase the notes. We would just say there's 3, we want to be a reliable source for them. We want to be a reliable buyer for the CDFI. That's enough. Like the goal here is not to find 1,000 banks that work with EBA Fund. It's to find the banks where this is the right strategy and works for them long term. And then, you know, EBA doesn't spend a ton of time trying to go out and market these notes.
Right. Great. Exceptional. So Joyce, from a strategic perspective, what are some of those ancillary outcomes you're hoping to realize through the EBA Fund regarding the role of business ownership and as an economic opportunity strategy?
Yeah, sure. I think, you know, perhaps most importantly, we hope that EBA Fund is a tool for helping more CDFIs to do more microlending and to reach more entrepreneurs of color and women. And, you know, as Brett mentioned, there have been many CDFIs that have sort of chosen to limit the amount of microlending that they do because of the economics. You know, it's hard to make a choice to make lots of these loans. And we think it's probably particularly hard for CDFIs that are led by people of color, which their, you know, data show have been historically less well capitalized and less well funded than those that are white led. And so it's often the most challenging for them because they're the most financially constrained. So just like, you know, businesses owned by people of color have greater challenges sort of raising the financing they need to grow their business. We've seen the same thing in many cases for CDFIs led by people of color. So what we're trying to do is make the financial choice easier for them, make the financial model and the economics better for them. That gives them the ability to move into microlending. And as Brett mentioned, like the first part is getting the financial sort of solution for them. And then there's potentially a capacity building solution as well. So, but when we talk about building the capacity of CDFIs that want to do more microlending, we have an explicit focus on CDFIs that have a strong record of lending to business owners of color and those that are led by people of color.
Got it.
That's one sort of big mission outcome. I think, you know, the other ancillary outcome I would talk about as part of our work is that we really want to help investors, funders, bankers, and policymakers, as well as folks who lead CDFIs, to understand that if we're going to grow small and micro business lending at CDFIs, those institutions need a more robust set of financial tools and strategies.
Right.
So CDFIs are, you know, always important, but when you think about particularly like the small business, the CDFIs that do small business lending, they are countercyclical lenders in times of crisis or recession. So more people come to them as the banks sort of tighten up their credit criteria. We are certainly seeing that now. We want them to be actively lending in times like that.
Right.
But if you think about it, like banks have a lot of tools to manage liquidity and manage risk.
Right.
But CDFI, small business lenders, have a pretty limited financial model and pretty limited financial tools right now.
Right.
So their model is like, we raise net assets through donations and we borrow money to leverage that. But in times like that, that's a very challenging financial structure for them.
It is.
So, you know, we've been really focusing on EBA Fund as a solution on the ground, but we've also been speaking with funders and investors and policymakers, folks at the Fed, folks at the Treasury, about this issue. Like, how do we get more tools, more financial tools into the hands of CDFIs? And a secondary market, which is EBA Fund, is one of those tools.
Great. Wow. Such impressive and brilliant structure that you've created and a new tool for our toolbox. I'm so excited and look forward to so much more impact as I witness your growth of the fund and your further partnerships. Thank you so much for all that great work and vision. I want to shift to end on a lighter and more reflective note. So what are you contemplating or looking forward to for the new year? Brett, do you want to start?
Yeah, I appreciate your asking for what we're looking forward to. It's been a challenging 12 months.
Yes, absolutely.
But I think part of the challenge for us is, as much of a roller coaster year it's been, we've really had our heads down trying to build a new nonprofit from the ground up.
Right.
And what that meant is that we have been very inward focused. And I'm really excited in the new year to actually spend time talking to more banks on the purchase side about EBA Fund as a tool. Like I really enjoyed those conversations before we started EBA Fund. We've probably talked to 50 or 60 banks in the last couple of years, but when you have a tool that actually adds value for the bank, adds value in the community, and helps CDFIs be successful, those conversations are really energizing when everyone comes in and they're like, oh wow, like I really can do something exciting. But we haven't had any of those conversations up until the last month because we just haven't been out there. So I'm excited to be out there again and talking to people this year and getting to have that excitement again.
Yeah, absolutely. Yeah, it's powerful. How about you, Joyce?
Well, I'm going to go back to something you said at the beginning, Linda, which is that this is really a time for CDFIs.
Right.
So I've been working on this issue of expanding economic opportunity through business ownership for, and working with CDFIs to do that for more than 25 years.
Yes.
And because of what's happened over the past year, there is a focus on supporting small business owners and particularly small business owners of color and women, on the part of corporations and foundations and banks and investors and policymakers that we've never seen before.
I know, finally.
So, yes, finally. So I think there's an incredible opportunity to address a history of systemic and structural exclusion and I hope we can seize that moment. I do think it's going to take hard work, like that interest and that commitment is important. But these are organizations that have been under-resourced for a long time.
Yes.
And it's not easy running a financial institution.
Right.
So there's going to be a lot of work, but I'm really looking forward to being able to sort of take it on from a new level of interest. And frankly, a new level of commitment in terms of financial resources to try to do that.
And to have a new tool that's structured as a nonprofit that serves to realize impact in many different ways. So let me close with my last question. What are you reading as of late or doing that really feeds your soul during these challenging times? Brett, do you want to start?
So I live in Minnesota and it is cold and snowy. But my family, we're not native Minnesotans, but we have really embraced the aspect of Minnesota, which is that when it's cold and it's snowy outside, you actually go outside. So we've been snowshoeing and ice skating and sledding. And, I think that sort of attitude that, many people think of winter as dreary and sad, and Minnesotans kind of always find the joy and the beauty and stay active in the winter. It's been really refreshing for me. And, I'm hoping that maybe that'll translate into the rest of 2021 too. As more challenges come up, we find a way to embrace it and find the silver lining in it. So awesome. That's what I'm going to try to embody this year.
Excellent. How about you, Joyce?
Yeah, well, I think there are probably others who are listeners to you that are in the same experience that I'm having, which is that I have 3 20-something age children, 2 of whom are living with us right now because of circumstances related to the pandemic. And one of the things that's actually really fun is I find the music that I listen to has broadened probably exponentially. So, I used to listen to the same old stuff that I've been listening to for a long time, but now that their playlists are echoing through the house, I'm exposed to new genres. And that's really fun. And then occasionally, like when I was cleaning the kitchen over the weekend, they'll put on like a Motown playlist.
Ooh, love it. I
so
love
that's
it.
also fun to know that they're listening to that same old stuff that I've been listening to. So that's been really nice.
Oh, that's nice. I have teenagers, so I completely understand the range of music that flows throughout the house. And we try to influence them to the old, awesome, wonderful works of art like Motown and others. So I'm just so proud to stand with the two of you in this community development space. And it's such a unique time in our nation's history. I just thank you for your vision and your commitment to this work. And I really look forward to seeing the EBA Fund thrive, as well as our CDFI network as they strengthen their balance sheets and their opportunities to really address these challenges of financial inclusion and economic development and opportunity, and really closing that racial wealth gap. Thank you so much for all that you do, and for also taking the time to share with me about the EBA Fund today. Thank you so much.
You're welcome. Thanks again for having us.
So we will have show notes so that you can learn more about the EBA Fund, as well as microenterprise, some of the early adopters to the EBA Fund in terms of investors, and some of the partners. So until next time, bye for now.
Thanks for listening to the CRA Podcast with Linda Lewis-Azuka. If you like what you just heard, we hope you'll pass along our web address, cratoday.com. Don't forget to leave us a positive review on iTunes, and be sure to check out our archive section on our website for previous podcasts. Join us next time for another edition of the CRA Podcast.